Hey you, yes you, long-term investing got you bored? Tired of seeing others making huge gains within 1 month while you sit and watch your steady, reliable increases on your quality stocks? Introducing Crash. One pill a day will get you excited about investing again. With one pill per day, you will start to watch dozens of videos a day about stock market crashes. You will start to day trade. You will only invest in penny stocks, meme tokens, SPACs and specs, options trading, and more. So dump all those quality stocks and start getting excited about investing again with Crash. If you call now, you will receive our exclusive offer for a 1 month supply of Crash for 38 easy installment payments of $20.22. Side effects will probably include losing all your money, depression, anxiety, financial ruin, inability to retire early, and saying bye-bye to your financial goals and dreams. So what do you say? Call and get your bottle of Crash today and get excited about investing again. Hope you like my little parody, my shot at acting. I don't know if I'll get an Oscar for it, but I hope you enjoyed it. And it's made to make a point here, okay? How many times do we hear about the stock market crashing? It's literally every day. You go on YouTube, Reddit, any platform, people are crying out the market's going to crash. Yet, the average market crash is once every 8 years. So this is doing a huge disjustice when people are trying to claim market crashes because it's keeping people out of the market and it's keeping them from making gains, which I'm going to show you a chart here in a little bit about why it's preventing people making money. And so I don't like when people do this. In fact, if you hear people screaming out a market crash, don't listen to them because nobody can predict it. The other thing that people are doing is, how often are we hearing about people, pushing in our faces every day, get into this penny stock or this spec stock or get into this risky asset, some type of crypto that's not well known. And this is causing people to lose a lot of money because they're taking big risks. And so that's also doing a disjustice to people. And you have all this going on social media everywhere and people buying into it. And so let's face it, what I do is long-term investing. And disciplined long-term investing is not sexy. It's not a sexy way to invest. Those other ways are. They draw your attention. It's why marketing works for a reason. But the vast majority of people that invest for, long-term in quality stocks or ETFs make a lot of money in the long term. It's just how it's always worked. In fact, if we look at the S&P 500, look at this over decades. Do you see anything here different? Look at the Dow Jones. People predict stock market crashes, but do you see a point in time on these charts where the market's crashed and has never recovered? No. Why? Because here in America, our companies are working hard to always improve and innovate, and that's not going to stop. And so I'm still very confident in putting my money in long-term quality stocks or ETFs, or just being diversified. And so, there's a lot of people that predict stock market crashes outside of these small-time YouTubers or Reddit posts. Big famous people do it as well. Michael Burry, companies like Goldman Sachs or Peter Schiff, and they've been wrong the majority of the time. Michael Burry got lucky with the 2008 housing crash, but since then he's predicted stock market crashes and they have not happened. And there is this article here that I thought was extremely interesting that says, even the professionals, even the people that work with stocks all the time, the Wall Street experts, have missed every single market crash in the last 20 years. And they're saying, why do you think brokers aren't telling you about stock market crashes? Because you can't predict them. And that would be a bad broker that if you're listening to and they're claiming a stock market crash, they would not be doing you justice and they shouldn't be in this business. And so let's take a look at Zillow real quick. They've been in the news, right? Their stock has crashed. Why? Because they were trying to buy up houses and using their algorithms predict the cost of the houses 6 months later so they can sell and make a profit. Well, their forecasting, their predictions were absolutely wrong, and they lost a ton of money. And it goes to show you, you can't predict the future. No matter how good you think you can, you can't. And a lot of these companies are very boastful about being able to do this, but it never works. And Zillow, even the CEO, is having a hard time admitting this, but it's exactly what happened. They can't predict the future, not even, the 6 months in advance. They ended up losing a lot of money, and they laid off 20 to 25% of their workforce because of it. The problem too is a lot of people fall for this. Somebody predicts a market crash, year 1 doesn't happen. And they predict it year 2, year 3, year 4. Well, in year 5, let's say there's a market crash, all of a sudden, I was right, and people fall for that. It's like, no, you said it was gonna happen 5 years ago, you said 4 years ago, 3 years ago. You can't keep guessing till you get it right. That's not how it works. And so I wanna show you guys some very elementary drawing that I made, but this is what I want you to take away from this, okay? So on the very left, we have it circled in red with the letter P. Let's say you listen to somebody and they say the stock market is going to crash where this red circle is, okay? That's the prediction. And let's say you listen to it and you keep your money out of the market because this guy is very certain the stock market is going to crash. He's putting up a good case for it, okay? Well, let's say year 1 goes by, those are years at the bottom, year 2, year 3, year 4, year 5, and let's say the market doesn't crash till 5.5 years later, and it crashes 20%. And you're like, yes, I'm gonna buy in, I saved all this money, and I'm gonna buy in, and let's say you even perfectly time the bottom, which is almost impossible, but let's say you do. Look at how much money you missed profit-wise. Okay, because in that 5.5 years, the market went up 60%. You would have made 60% gains on your money. Mind you, the S&P 500 goes up an average of 10 to 11% every year and has since 1926. So the stock market goes up 60%, and that's the time you kept your money out of the market. You have a 20% dip, you put all your money in. You think you're winning, but in essence, you've lost out on 40% gain in your money. And that's not even including dividends that you probably would have got paid and reinvested. And this is what people struggle with is, yeah, I'm gonna wait, keep my money out of the market till the market crash, but that whole time you're missing out on gains that you could be making because the market has always recovered. And so in this example, you could have made 60% gains with the market crash, though down 20%, you have still been up 40% with your money. Where if you got in at the low, you're missing out that 40% you could have made all along, plus a lot more with dividends. Now, let's say it takes 1.5 years to recover, then great. You've made, let's say 20%, but you could have made 60%. And this is a perfect scenario, mind you, which it's almost impossible to time the bottom. What happened with this last, with the pandemic is the market took a dive and people all threw their money, or they took all their money out of the market because they thought it was going to go lower. But instead, it turned around and has gone up since, and a lot of people missed out on gains. So in this example, they timed the bottom perfectly, but that's almost impossible. So in essence, you're probably, let's say you get in on the 10% dip, then you're missing out on 50% gains of your money. So I hope you guys take this chart, as elementary as it is, and really think about this. That's why it's great to just keep your money in the market. Keep on investing, do it regularly. I do it bi-weekly with my paycheck, but I think at least once a month is great. And this will prevent you from losing out on a lot of gains because you chose to listen to some guy saying the market's going to crash when it's not. In fact, a friend of mine, with the pandemic, when the market went down at the very low, he sold out because he was listening to people saying it's going to keep crashing, and it turned around and he had to buy in at higher prices and missed out on a lot of gains. And so it's very hard to see these people try to predict stock market crashes or get you to invest in risky stocks because It's really like putting your money into the lottery, okay? How many people do you know have won it big on the lottery? I've known none. Or on the stocks, risky stocks. I don't know one person that has made a lot of money doing it that way. Instead, I've known plenty of people to lose money that way, and a lot of money. And so please be very careful not to just buy into people that are speaking out on Reddit, buy this speculative stock, it's gonna go up high. At that point, it's probably too late. So in my opinion, 90% of your portfolio should be in solid quality stocks or a few great ETFs, and then maybe play with your 10% or less in some more risky investments. But be prepared with that 10% or whatever you decide, 5%, 2%, be prepared to lose all of that, because that's exactly what is most likely could happen with that money. Instead of investing in diversified quality stocks or ETFs, where long-term it's been proven, those make people wealthy. The majority of people make money with long-term investing, diversifying their money in quality companies. That's how you make money. Taking those risks, yeah, you're going to see a few people that make it big, but that's a few people. The majority of people lose money. And it's sad that people buy into that. And I get it, marketing works, but you got to be smart when it comes to your money. And like I said, since the inception of the S&P 500 in 1926, it's returned an average of 10 to 11%. Think of it this way, 10 to 11% in the S&P 500 a year, you're getting 10 to 11% raise on your money yearly, where the average US raise is 3%. Think about that. Your money in the market's making over 3 times more of a raise than your job. And so why do you want to risk putting all your money into a risky stock when you're probably going to lose it, when you could be making a 10 to 11% raise a year, where jobs average about 3% raise a year on your salary? So think about that, 3% versus 10 to 11% annually. I'd rather put my money where it's making 10 to 11% raise each year. That's like a promotion every year. And so just putting that into perspective as well. So I wanted to make this video just because I see way too many people around me still taking those high risks, still keeping their money out of the market because there's going to be a crash. Choose good quality companies. Choose the companies that you will invest in for the long term, that you believe will be around in the next decade or two. Put your money into ETFs. If you don't have the time to really put into the individual companies that you invest in, let the ETF do it for you. So this is, I hope this video really helps you to put things back into perspective. I think we all, it's just our human nature, like that, those flashy headlines, or to be like, yeah, I want to make some quick money, but always learn to take yourself out of that and just think about it. Go watch this video again. Every time that you get into that mode, come back and watch this video. And so I hope you guys like this video. Please subscribe to my channel. Please like my video. I really appreciate the support. I really want to grow this channel. And I hope you guys have a great weekend, and we'll see you next time.